Welcome to the deep dive. If you've ever felt just overwhelmed by all the market noise out there, well, this analysis might just be your antidote. Our mission today is really to cut through the speculation and deliver the core insights from a very specific proprietary source. We're talking about the LoopMarket Weekly Analysis. This one was authored by Devin McClarty for October 13-17, 2025.
Right.
And it's published by D Publishing Group, owned by D Investment Enterprise, LLC.
Right.
This isn't just looking at market action, is it? It's really about decoding why things happened. It feels like a roadmap for the serious investor.
Absolutely. And, if we had to boil down the entire philosophy guiding McClarty's work this week, it really comes down to precision over speculation. That's the key phrase. This whole framework, it's designed specifically to read the true rhythm of institutional capital. And the main takeaway for the week, it was pretty unambiguous. True market performance was driven by structure, not sentiment.
Structure, not sentiment. Okay, so our goal for you, the listener, is to really understand the mechanics behind this. We want you to grasp how this proprietary LoopMarket methodology decodes what they're calling behavioral flow and why that underlying foundation mattered, well, so much more than maybe the daily headlines during this period. Okay, let's unpack this then. The core framework, behavioral flow, that's a term we probably need to define, functionally speaking. It sounds like it's beyond just tracking prices or simple volume. What is the LoopMarket framework fundamentally trying to achieve here?
Yeah, it's think of it like the difference between just watching the tide rise and actually understanding the gravitational forces causing it. Behavioral flow is really about tracking the, let's say, methodical placement of institutional capital. We're talking about the money that moves with real strategy, deep conviction. Not necessarily the, emotional decisions maybe driving retail trades. The analysis focuses strictly on what they call foundational strength. Clardy's argument is essentially that if a stock system is truly optimized, then the price move. It's just a manifestation of that underlying strength. So therefore, the significant breakouts they saw, they only came from, and this is their term, systems with foundation, not noise.
Okay, so if I'm following the market the usual way, maybe watching news catalysts, social media buzz, whatever, I'd be looking at sentiment. But you're saying this analysis specifically filters that out and asserts that structure, and not sentiment, was the actual driver. How exactly do they measure that structure? What does that look like?
Well, they measure it by confirming causality. That's the key. You see, sentiment is reactive, right? Something happens, the market reacts. Structure, in their view, is anticipatory. So if a stock jumps 10% because of some great news announcement, okay, that's sentiment. But if a stock jumps 10% on high conviction volume before that news is widely known or digested, and it's based on their internal indicators of system optimization, that's structure.
Oh, okay. Got it.
The core claim here is really that the market winners during this period weren't just lucky, they were the direct consequence of underlying disciplined capital flows, money moving into assets that met specific non-emotional criteria for being optimized.
That sounds incredibly disciplined.
Yeah.
So let's jump into the market environment itself. What was the overall rhythm, the mood during this specific week? Where was the real heat?
Right. So the overall polarity for the week, as they put it, leaned green. Definitely a bullish bias. But, and this is crucial, it wasn't like everything was just rising together. The market had a very distinct cadence, and it was really set by sector leadership. Telecom and AI were instrumental. They were leading the rhythm.
Telecom and AI, interesting.
Yeah, and that's important because it sort of confirms that capital was aggressively rewarding these secular long-term growth stories, specifically things focused on infrastructure and next-gen computing.
Okay, but was this just fast money, speculative cash jumping in and out?
Yeah.
Or was it the kind of capital that actually builds durable trends?
That's exactly where the volume confirmation comes in. The analysis explicitly noted that the volume confirmed conviction. It wasn't just short-term hype. When you see large directional moves backed by heavy, sustained volume, it adds this layer of durability to the shift. It really reinforces their thesis that these moves were structural. They were meant to last longer than just, a single trading session.
Okay, now here's where we get into some of their unique metrics. The report uses terms like EV% spread, EV% momentum. That sounds like it's deep in the engine room of this analysis. Conceptually, what is this metric telling us about the velocity of capital flows?
Right. Think of it maybe as an acceleration measurement for institutional conviction. standard momentum that just tracks speed, right? EV%, it tracks the change in that speed. Or you could say the velocity of capital entering a specific system. It's specifically measuring how quickly capital is flowing into certain systems relative to others.
Okay, acceleration, not just speed.
Exactly. And this metric showed that the growth and telecom sectors, they didn't just participate in the rally, they carried that high velocity into the next cycle. That positioned them really strongly going forward. It's basically an indicator that institutional demand wasn't tapped out yet. It was actually still accelerating in those areas.
That shift in velocity. That leads us right into a really crucial macro observation McClarty made. The analysis noted the market demonstrated a shift from rotation to expansion. Now, this sounds like a sophisticated point. Can we clarify that for the listener? What's the fundamental difference between market rotation and market expansion in this context?
Good question. So rotation, think of it as capital just shuffling between existing sectors, like everyone moving chairs around in the same room. The money might leave, say, energy and flow into healthcare, but the total amount of capital in the market basically stays the same.
Boy.
Expansion, though, that's different. That's new capital actually entering the entire market system. It's like new chairs being brought into the room.
Adding more capacity.
Precisely. And expansion is generally seen as a profoundly bullish long-term indicator. It suggests increased overall systemic health, more participation. It's a bigger pie.
Right. And was there a specific signal, like an early momentum builder, that flagged this healthy expansion phase kicking off?
Yes, there was. It was QUANTX. According to the report, its emergence as a quiet but strong early momentum builder was the critical signal here. It wasn't, grabbing all the headlines, but its sustained structural move showed that capital was getting comfortable moving beyond the typical defensive safe havens, and was starting to aggressively pursue new, maybe higher risk growth opportunities. That shift, that's really the heart of what expansion means in practice.
Okay, fascinating. Let's move into the granular review now, segment 3. Looking at the specific stocks, which the analysis puts into these distinct zones: leaders, stabilizers, and laggards. Let's start with the breakout leaders, the ones that really prove this foundational strength thesis.
Right. There were two prime examples highlighted. First one was LUM. The analysis said it confirmed a full breakout. Now, this wasn't just, the price going up. It validated LUMN's internal system optimization within the telecom sector. It established clear structural leadership there, and it confirmed that sector cadence we talked about earlier.
Okay, so LUMN was one.
Second one was HPE, Hewlett-Packard Enterprise. This name extended its existing leadership in what they called the critical cloud and data center lanes. And this movement, it just reinforces that whole thesis that infrastructure, the actual physical underpinning of AI and digital transformation, that's where serious institutional conviction is flowing. These moves weren't about hype, they argue. They were about necessity and foundational strength.
Makes sense. Okay, next up we have the stabilizers. WU and USPH landed in what they call the match zone. Can you help us define this match zone functionally? If the leaders are accelerating away, what does a stabilizer in the match zone tell us about the market's health or structure?
Yeah, the match zone basically characterizes stability. It's a state of controlled flow rather than volatility, as they put it. It suggests a kind of highly disciplined equilibrium where institutional supply and demand are more or less perfectly balanced for that stock. So these stocks, they aren't really eroding value, but they're not accelerating yet either. They're holding steady.
Okay, so it's a sign of confidence.
Exactly. For the listener, it signals pretty robust confidence. The market trusts the underlying foundation of these companies enough to hold them, preventing sharp drops. But they haven't quite received that full rotational capital needed to trigger a major breakout yet. It's kind of a sign of maturity in their specific flow profile.
Got it. Holding pattern, but a strong one. Now, the flip side, the laggards. HSY, Hershey, continued its slide, entering what the analysis terms the profit zone. HSY is a classic defensive staple. What does this profit zone tell us about capital maybe fleeing from those defensive names?
Right. The profit zone in this specific context signifies a strong downward trend. But importantly, it's associated not really with short sellers attacking the stock, but more with institutional profit-taking. HSY's slide, according to the analysis, highlighted defensive exhaustion and margin pressure across consumer staples.
Defensive exhaustion. Unpack that a bit.
Sure. So defensive exhaustion means that institutions had likely parked capital in safe defensive names like HSY during earlier periods of market volatility or uncertainty. But now, with the market showing signs of shifting into expansion mode, that capital isn't earning competitive returns anymore. It's just sitting there. So managers realize, hey, I'm actually being penalized for playing it too safe. So they actively liquidate those positions to free up cash and pursue higher returns in those growth sectors we talked about, like tech and telecom.
Ah, okay. So the money flowing out of HSY is directly fueling the money flowing into names like LUMN and HPE.
Mhm.
It's not just a coincidence, it's part of that rotation, but also boosted by new expansion capital coming in too.
Precisely. That's the connection the report makes, which is quite insightful. The structural thesis holds up. You see disciplined capital flowing out of defensive names, confirmed by volume, and that same capital actively seeks out and fuels these conviction-driven structural breakouts in AI and telecom. It's basically a textbook risk-on shift playing out.
Okay. Before we wrap up with the final takeaways, we should probably just briefly touch on the nature of this source material itself. This analysis by Devin McClarty, it's explicitly presented as proprietary IP, a structured vault asset. What does that kind of framing tell us?
Well, it underscores that the methodology itself is treated as valuable intellectual property, owned by D Investment Enterprise LLC and published via D Publishing Group. It's not just casual commentary. The fact that the framework is protected, rigorously defined, with all these specific metrics like EV% spread and the structured zones, it means the intent behind it is absolute precision. They're essentially providing a structured system, a repeatable method for decoding market movement. It emphasizes that structure and methodology are absolutely central to their whole value proposition.
Right. It reinforces that idea that the precision they're aiming for isn't accidental, it's engineered.
Exactly. And it's a part of a larger ecosystem. The report mentions the financial engine as the licensing house managing a whole suite of licensed audiovisual IP. They even list some unique names like LoopSpeak, LoopCourt, LoopFear, the Algorithmic Church. It just shows the breadth of the structure built around this core LoopMarket framework.
Interesting context. Okay, so let's pull back then. What does this all really mean for us? If we had to distill it down, what's the most essential, unambiguous lesson that this loop market analysis for October 2025 delivers to you, the listener?
I think the core lesson is the primacy of structure, period. The market, in the snapshot, clearly rewarded structural advantage and system optimization. The noise, it was secondary. So if you were an investor who managed to filter out the daily hype, the sentiment swings, and instead focused on where that disciplined institutional behavioral flow was actually moving capital, if you could identify those foundational systems that were accelerating their velocity, you were rewarded. You found the durable, conviction-driven breakouts. This analysis really provides a kind of template for understanding that the market, maybe more often than we think, is a story of engineering, not just raw emotion.
Structure over sentiment. Engineering over emotion. Okay. That brings us neatly to our final provocative thought for you to chew on. Consider this entire analysis, it focuses on decoding structural movements, right? The disciplined placement of big money. So if that structure, if that institutional capital flow is already dictating the outcome, does following sentiment, what people feel about the market day to day, does it even really matter that much? Or is sentiment maybe just the final ripple, the noise that distracts us from the foundational structure that's already been written into the flow? Something to think about next time you evaluate a market signal or hear a prediction. Thank you for joining us for this deep dive into the Loop Market Weekly analysis. We really hope you feel informed and maybe armed with a slightly different perspective on market structure.